Today we're going to discuss cash flow statements. The general rule with a cash flow statement is that all inflows of cash are shown without brackets and outflows are shown in brackets. We're going to look at the basic layout. There are three sections to the cash flow statement. The first section is cash flows from operating activities. Now, operating activities is your normal income, expenses, current assets like debtors and stock, current liabilities like creditors. All activities concerning those items are considered to be operating activities, and their cash effects will be shown in the first section. The second section is the cash flows from investing activities. When you invest in non-current or fixed assets like property, plant, or equipment, or when you simply invest cash in a fixed deposit, those cash effects from those activities, buying and selling, will go into the cash flows from investing activities. The third section is cash flows from financing activities, which is anything to do with raising capital, share capital, buying and selling shares, or anything to do with loans, raising a loan or paying a loan back. Those three sections must be in this order. Firstly, the cash flows from operating activities, then the cash flows from investing activities, and then the cash flows from financing activities. The order is important. Operating, investing, financing. OIF, O-I-F, operating, investing, financing. The summary or the net effect of these three sections explains why your cash balance, your bank, along with petty cash and cash float, it explains why your cash balance changed from whatever it was at the beginning of the year to what it is now at the end of the year. And you prove that by taking the cash at the beginning of the year, adding that net change in cash and getting the cash at the end of the year. But that section we will do later. In this video, we're going to focus just on the first section, on the layout and how do you get this layout into your head. Our first section is cash flows from operating activities. The first line being our cash receipts from our customers. We are going to do a calculation to determine exactly how much money we have made in the form of sales from our customers, and this will be shown as a cash inflow. We then subtract the cash paid to suppliers and employees, and this will be shown as an outflow in brackets, and that is why we will subtract it to get a subtotal called cash generated from operations. Now this figure we're going to do a note to get to that number, and we will do the note and the calculation in a little while. Certain items are required to be disclosed separately. Now anything to do with interest, dividends, or tax must be separately disclosed, whether it be interest received or interest paid, dividends received or dividends paid, or income tax paid. All items to do with interest, dividends, and tax must be disclosed separately, and therefore they will not be included in the top two sections, the green or the red line, the cash received from our customers or the cash paid to my suppliers and employees. And that gives you the total of that first section. Let's begin with the note. The note reconciles the profits before tax with the cash generated from operations. It takes the profits before tax and it makes certain adjustments. And it reverses certain items so that we are left with just the cash flows that are included in those profits before tax. So for that reason, we're going to make some adjustments for non-cash items. There are certain items in the income statement that are included in calculating the profits before tax that are not cash. Things like depreciation. Nobody paid anybody. Profit on sale of asset, loss on sale of asset. Those two are not the cash price. The proceeds, step 4 of asset disposal, is the cash flow, not the profit or the loss. And then, as I said earlier, there are some items that have to be separately disclosed: interest, dividends, and tax. And if any of these were used to calculate the profits before tax, we need to remove them so that we can show them later, almost like a cut and paste exercise. So in this section we're going to cut them, and then later we will paste them by putting them in where they go. So it's just a moving of these items. But now not all of them were used to get to the figure for profits before tax. Any interest received and interest paid would have been used to get to profits before tax. Dividends received would also have been used to get to profits before tax. But dividends and tax paid were not used to get to profits before tax. Profits before tax is what it says, before tax. Dividends is only there in the note to owner's equity. So therefore, only 3. Dividends received, and interest paid will come in here. We then subtotal at this point. And that subtotal is called operating profit before changes in working capital. So that means we're going to now look at the changes in working capital. Working capital is current assets and current liabilities. Those current assets and current liabilities that form part of the operating activities. Current assets, like I mentioned before, are your stock and debtors, and your current liabilities under operating activities are your creditors. Let's begin with inventory. Now, you're going to look at the difference between your opening balance for inventory and the closing balance for inventory and determine whether your inventory went up or down. Now we're going to show the cash flow effect in this section. Remember, we're doing the cash flow statement. So we want to know what is the cash, what is the effect on cash because my inventory went up. If I've got more inventory, I paid for it and therefore my money flowed out. And therefore the amount, the difference between the opening and closing inventory, will be in brackets. My debtors, I'm also going to look, did they go up or down? Now think of the easy one. My debtors are going to pay me and then they will decrease. If they pay me, money flowed in. But if they increase, they did not pay me and I have less money than I would have had if they'd paid me. Kind of like I've funded their spending. Creditors. We're also going to compare the opening and closing balances and see by how much they went up or down. Now always take the easy one first. My creditors will decrease when I pay them. So when I pay them, it's an outflow and I'll put that in brackets. Let's look at the opposite. If my creditors increase, that means I did not pay them. That means my money, my bank balance is bigger than if I would have paid them. So pick the one that works for you. Inventory increases, money flows out. Debtors decrease, money flows in. Creditors decrease means we've paid them and money flowed out. And the final answer would be taking the operating profit before changes in working capital, adding and subtracting the cash flow effect of the increase or decrease to debtors, inventory and creditors, and that'll give you the figure cash generated from operations. And that is the amount that you will fill in over there. Right, let's look at that calculation. We're going to look at my customers. The only customers who owe me are my debtors. So we're going to look at the opening balance for my debtors, and we're going to look at the closing balance for my debtors. Debtors are assets. So the opening balance will be on the left, on the debit side, and the closing balance on the credit side. My debtors increase when I sell to them. So I will add that to my opening balance. Now the only amount that is missing is the bank figure. So if I balance this debtors account by taking the big side, minusing the balance carried down on the little side, I will get a balancing figure or the missing figure, and that'll be the amount of cash that I have received from my debtors. Simple T account, fill in all your numbers and find the missing one. Or you could do it in a calculation format where you take your opening balances for your debtors, you add your sales, and you subtract the debtors' closing balance, the one at the end of the year. And the answer will again give you the cash received from your debtors. And once you've got that amount, you fill it in at the top of your cash flows from operating activities by the first line, cash receipts from customers. The next line, cash paid to suppliers and employees. Where do you get that number from? Well, you take your first number that you calculated, cash receipts from customers, and you subtract the amount that you got from the note, the cash generated from operations. The difference between these two will give you the cash paid to suppliers and employees. And don't forget, when you fill in the cash paid to suppliers and employees number, you must put it in brackets. Always check it from the top. Check that your cash receipts from your customers, an inflow, no brackets, minus the cash paid to your suppliers and employees, an outflow in brackets, will give you the cash generated from operations which you got in your note. The last little bit of this section are our separately disclosed items. How do you get to those numbers? Interest received and dividends received are very similar calculations, so I'm going to do them together. To work out how much interest or dividends were received during the year, you would take any outstanding accrued income for that interest or dividends at the beginning of the year, the opening balance. You will add any interest or dividends received during the year, that which appears on the income statement, and you will subtract any accrued income for that interest or dividends received at the end of the year, because you have not yet received that. When you total this, you will get the total amount for interest or dividends received, and you will fill that in on the face of the cash flow statement without brackets because they are inflows. Interest and dividends received, inflow. Interest paid, very similar calculation. You'd start with accrued expenses for interest, outstanding interest at the beginning of the year. You add your interest for the year from the income statement, and you subtract any accrued expenses for interest at the end of the year because that has not yet been paid. You total this up and it'll give you the amount for the total interest paid during this year. And you fill that in also on the face of the cash flow statement in brackets because it's an outflow. You paid the interest. Dividends paid. You will take your dividends payable at the beginning of the year, or they are sometimes called the shareholders for dividends. You will take the dividends payable, the shareholders for dividends, at the beginning of the year. You will add your dividends for the year, there in the note to owner's equity. You will subtract any dividends payable at the end of the year, those shareholders for dividends at the end of the year that have not yet been paid. When you total this, the amount that you get will be the total dividends that have been paid. And you will fill it in on the face of the cash flow statement in brackets because it is an outflow. The last line item is our interest paid. You will also start with the tax that is payable at the beginning of the year. You will add your income tax for the year from the income statement, and you will subtract the closing balance for tax payable. And that, when you total it up, will give you the total tax paid for the year. You may do these in T accounts or in calculations. Either way, you will get the same answers. You will fill the tax paid in on the face of the cash flow statement in brackets because it is an outflow of cash. Remember, any of these calculations can be done in a T account with the opening and closing balances, or they can be done in the calculation format that I showed you. Either is 100% correct. In the next video, we will look at the cash flows from investing activities and the cash flow from financing activities. And lastly, we will finalize the cash flow statement and look at the entire layout from top to bottom.